All right, welcome everyone. Episode number 26 of the Wide Lens podcast. Woo-hoo. And all of our technology is recording.
No false starts today.
The Rodecaster,
we're good.
Riverside, the Sony cameras are running. We are all good, I hope. Yep, all good. And I've got Matt Rigby here to cover the latest topics in financial markets, and we're recording this on Friday the 5th of August. And let's get straight into Matt's Market Minute.
We're into it. All right, the Aussie ASX 300 up 1.25 for the last 5 days. Down 8 1/3 for the year to date. Just not too bad.
For the calendar year?
Doom and gloom, calendar year from 1 January. So we're now getting into reporting season. It really ramps up, I think, next week and the following week. So there'll be some really interesting details come out over the next few days. A couple of companies that announced over the last few days, Aussie Broadband, the small telco, the 4th largest telco in Australia, I think. Probably have that wrong. Anyway, down 11%. They came out with pretty good, fourth quarter guidance that was a bit slower than expected, but growth and earnings were still kind of at the top end of their range. So it was a bit of a mixed bag. But, you know, they're fighting for market share against the big boys. Lynas came out with a $500 million expansion to their big mine in WA, Mount Weld. They're up about 4.5%. Appen down about it's almost 25%. Their first half 22 earnings downgraded. Basically, the big US tech companies are no longer or cutting back or stopping spending altogether. So that's been a big hit to their earnings. And I think their guidance was pretty average as well. A2 Milk up about 13.5% on expectations that the US FDA are going to approve for their baby formula to be imported into the US. Remember, we talked a few weeks ago about that massive shortages in the US. So that's a huge market that they'll get access to. And Credit Corp came out with better than expected results. However, the outlook was pretty weak. They're down about 3.3%.
Just on that, A2 Milk Company leading up into the pandemic, share price close to $20.
Yeah.
It's $5.
Yeah. They have massive problems. Remember, China went through their whole anti-Australian, maybe they're still there, Treasury Wines and all those guys, and they got caught up basically.
But Treasury Wines has come back a bit since then. A2, I don't know, it just looks bizarre. Like if I look at this chart, it's a massive rally, and it looks like it basically peaked when, in fact, during 2020. That's weird.
Right. I also know that they had some inventory issues.
Yeah, we talked about that. Yep.
They've got a new CFO, David Muscat. Come on, Davo.
What's his background?
Earn your money. He was the CFO at Pacific Brands.
Oh, yeah.
And then they got taken over by Haynes, then CFO for Haynes Europe, and now coming back to be CFO.
Hold on, he resigned.
Who?
Oh, no, I'm sorry.
No, that's the other. So the CEO was the CEO at Pacific Brands. Anyway, so there you go. But yeah, they look, could be a big market for them. Could be, will be, whether they can crack
There's
it
also,
or not.
I mean, I think we talked about this a few weeks back. There are companies out now producing, you know how there's all these, lab-grown meats that...
Yes.
And so there's now lab-grown milks where they're going...
I saw that the other day.
They're basically replicating the process.
Yep.
It's a fermentation or whatever it's called.
Yep.
For milk. So it'll be interesting to see...
So a company just raised, I want to say $23 million.
Yeah, All G Foods, $25 million.
25, yeah. Yeah, interesting.
So they're the same guys that do the Buds burgers. So it's
okay.
Fake meat.
Yep.
And their target market is very much non-vegan, vegetarian, like meat-eating people, and that's their target market. So these guys are like meat stock all around the country, like really trying to grill the barbecue with the others.
Yep.
And they look like they've just got a lot of traction. The CEO's quite an entrepreneur. I know he's run a number of other companies before.
Okay.
So yeah, they're going pretty hard.
Nice. All right. Getting back on track. The Nasdaq up 4% over the last 5 days, down 19.3 year to date. 42 down more than 20%, and 21 in positive territory for the calendar year. So still not looking great, but down 20%.
The bleeding has clearly stopped. It looks a lot better than
bleeding less. Yeah. Anyway, so S&P 500 up about 1.5% for the week, down 13.5 year to date. That's a big improvement on where it was at its lows. Rob, what's the S&P up year from the low point? What did we say? 13% from its lows this year?
13.24%.
Yeah. So
June 16th.
Big turnaround. Year to date, 130 companies positive. That's about 26%. 157 down more than 20%.
We talked about that last week. Yardini was saying the 3666 intraday low in June. That was akin to that of the 2009 666 low during the GFC.
Yeah, that's right.
We chat about that.
Yep.
We'll talk more about that later.
Big week for earnings. 1,646 companies have announced this week. So let's start at A. So Airbnb, we've got a lot to get through here. They're up about 10%. Came out with their earnings, not too bad. These are all beats. PayPal up 12, Starbucks up 2. Mercado Libre up 26.5%, with some massive earnings beat. $2.43 versus $1.80 expected. EA Sports up about 1, Gilead 2.6. Avis Budget, that was interesting. Car rentals, high demand, people traveling in the States, up about 3.3%. BP, no surprise, oil.
So people are renting cars and filling up petrol, driving to the Airbnb.
Stopping in at Starbucks along the way. Simon Property Group, interesting, down about 1.75%. Their outlook wasn't great, but it did beat. AMD, Advanced Micro, up about 14.5%. Markel, the mini Berkshire, down about 8%. Caterpillar, down 3%. I think their building segment was down, or the outlook's not great. Booking Holdings, talking about Airbnb, up about 1.75%. New York Times, down 3%, but beat on earnings. CVS, the pharmacy, up about 6.5%. eBay, down 2.5%. Elliott have a massive holding in eBay. Alibaba came out last night with better than expected results. They're up about 3%, but overnight, I think they're up at quite a bit. I can't recall, but making up for some losses. And Atlassian, up 12%, and just announced their earnings, up a further 10% after hours. So
still not paying any rent anyway. Everyone's working from home.
Is that right? They've gone.
They did. They've got 100% remote.
Yeah, absolutely. Under Armour met earnings, which is a big turnaround from what they've done previously. Uber missed, still up 37%.
Up on a miss.
Yeah, up massively on a miss. And they're still losing a shitload of money. I don't know if they'll ever be profitable. Activision Blizzard up about 1.5%. JetBlue 4%. Yum Brands down 2% on the miss. Pinterest up 18% on their miss. Not as bad as Snap. Sorry, Snap. Elliott also have a 9% stake in Pinterest. A couple of things that just sort of jumped out at me. Starbucks CEO came out and said demand really hasn't been an issue, announcing record customer demand in the third quarter. Robinhood cutting another 23% of their staff after 9% earlier this year. Tesla shareholders announced a 3-for-1 stock split, so they're up about 10%. And PayPal, I mentioned last week that Elliott management had taken a stake. That's now been disclosed at $2 billion. Announced a new CFO and a $15 billion buyback.
It's all happening.
And a $900 million cost-cutting exercise, which is code for future redundancies.
But that's not out of what is going on at the moment. A lot of the tech companies are slowing down recruiting.
Yeah,
you just said Robinhood cutting.
Yeah.
It's
Bloomberg actually have recorded or are tracking all the tech companies that have announced redundancy, and the list is huge.
Does Refinitiv have it? I'm sure Refinitiv would have it as well.
Yeah, possibly.
You should look at that.
All right, let's move on. Emerging markets, as gauged by the VGE Vanguard Emerging whatever ETF, down about 0.3 last week, down 14.5 year to date. Oil down 10% over the last week, still up 17 for the year, or 17.7, $88 a share, or a barrel, I should say. I read in Bloomberg this morning that oil peaked at more than $130 a barrel in March, has given up all the gains triggered by the Russian war in the Ukraine, falling below $90 a barrel for the first time in quite a while. Bitcoin down, I think that should be down 5% over the last week, 52% year to date, $22,485 a coin.
Yeah, it's been just trying to see, in and around. It's just, so it's up. So you know how we talked about the S&P 500 being up 13% from its June 16 low. Bitcoin bottomed out on 18th of June and up a measly 19% during that time.
Is that right? Okay.
Yep.
And that was down 5% for the week.
Yep.
Up 19%, still down 53%
From the
for the year.
For the year? Yeah, 50.5%.
Yeah.
50, whatever it is. Yeah.
What
else you got?
We'll cover the rest. It's got some economic stuff. We'll cover that in a little bit.
So one thing that I wanted to add to the Matt's Market Minute was...
it's not Matt and Rob's Market Minute. What are you doing, man?
I'm trying to just nudge my way in here. Did you see... and what I'll do, I'll bring this headline up as well from Bloomberg. This tiny firm just surpassed Goldman Sachs with a $14,000 gain. The convoluted ownership structure behind AMTD Digital points to Kelvin Choi, an ex-UBS bank. I don't know who this guy is. Ex-UBS bank who's fighting an industry ban in Hong Kong. I think with some issues around non-disclosure, conflicts of interest, etc. So this company, so they're a digital company, and they do a whole bunch of things in finance technology, marketing, etc. So they've got I'll bring this chart up now. It's so it's showing market cap, and it's sitting at a market cap of $204 billion.
Jesus.
Bigger than that of HSBC at $132 billion, Royal Bank of Canada, Morgan Stanley, Wells Fargo, and it has guess what the annual revenue is of a company that, I mean, you don't have this chart in front of you, so I'd love for you to guess.
$200 billion market cap company.
$204 billion market cap.
What's their revenue?
Annual revenue. Let me give you some perspective. Wells Fargo, 166 billion cap, $82 billion annual revenue. And this is more than Wells Fargo.
The revenue is more than Wells?
Or the market cap is greater than Wells.
Yeah. So I'm naturally going low side because you're setting me up for high side. So look, at 200 billion, 10 times sales would be 20 billion of sales. I'm going to go like 15 billion in revenue.
15 billion? 25 million.
Holy shit, are you kidding me?
25 million. So to give you a bit of an idea, Berkshire is at 650 minutes. Maybe that's not comparable. Let me find something. Look, Wells Fargo is trading at a 2 times market cap to revenue. Right?
Wells Fargo is 2 times.
So the annual
sales.
revenue is 82 billion. Their market cap's twice that.
Yep.
AMTD Digital is trading at 8,100 times market cap.
So it's a short.
Well, there's a whole bunch of stuff going on. You'll have to read the article. We'll put the link in the show notes if you want to have a look at it. But Wall Street's basically saying this is meme stock mania back again, and it is just. I think it's gone up more than since the article was written. I think I'm reading 21,000% or something like that since IPOing. People are saying the IPO was not that it shouldn't have been priced where it was priced, and a whole bunch of things. But
$25 million of revenue
of annual revenue.
Nothing.
So maybe one to watch for the short, see what's going on that front. But the ownership structure is so convoluted. It looks quite complex. I haven't looked too much into it, but I thought that would have been sitting on top of the best performers on Refinitiv, but not there.
I missed that one.
So should we maybe get to the first topic? Forecasting returns over the next decade. We've always talked about We always hear about, expected return and forecast and so forth. And I think trying to predict and forecast returns in the next 3 months or 6 months or 12 months, or in fact the next 18 months, is just a fool's errand. It's so hard to do. Even when companies give you guidance, once that guidance is provided, the market reflects that information really quick.
Yep.
I mean, trying to outsmart or have some intel beyond what the market has on companies like Apple, Google, BHP, NAB, it's just so hard to do because they're such widely followed stocks, right?
Yep.
And if you remember, do you remember during the GFC and even during COVID, we always talked about returns have been brought forward. Returns have been brought forward. We've got higher returns now, expect lower returns going forward. And so there's just this tug of war right now, I feel, between what is supposed to be happening in the market and in the economy versus what the data is showing. And so we just talked about the market bottoming out on June 16, up, call it 13, 14, 15%, whatever you want to call it. I feel like a number of things. Either the market has said we've priced in that minor recession, and I don't know whether it was what kind of recession we had. We talked about 2 consecutive quarters of GDP not being a recession. We talked about a number of different gauges on the dashboard that really need to be a lot worse than what they are for us to be in recession. And certainly for the first half of this year, we were not in recession. Whether we're in recession for the second half, we will find out. But the stock market's saying, and it appears as though for now we've bottomed out on June 16th, and maybe before you know it, we're going to click that 20% mark. We're in a bull market again.
Imagine that. Imagine if by the end of this month or early next month we're in a bull market.
Do you think that's impossible?
It's not impossible. No, it's absolutely possible.
What do you want to wager on that? Let's wager something.
Okay. How about your new car?
I will say the index will be higher in 10 years' time than what it is, and I'll wager the car.
No, not taking that bet. It's possible, right? I mean, who knows what the data comes out?
Let me ask you differently. Would it surprise you if at the end of this month or mid-September, the next 4 to 6 weeks, we've clicked 20% bull run?
7% over the next...
well, it's not really 7%, is it?
Well, we're up 13.
13,
right?
Okay.
In that period of time, I'd probably be surprised.
Okay,
but
so that would surprise
before the end of the year, I wouldn't be surprised.
Okay.
At all.
All right. Well, let's see where that goes. The reason why I'm talking about this is Vanguard had their June quarterly or half-yearly report come out, and the capital markets team have published their expected returns. And so I'll bring this up in a moment, but just to set it up, the likes of Vanguard and a lot of other market forecasters will generally, and I feel like this is probably the better way of looking at it, is looking at annualized returns over the next decade. Mm-hmm. So whether you look at different methodology, like whether it's Shiller's methodology, the Vanguard use, I think, the Jack Bogle methodology. Tim Farrelly uses a very similar methodology. There are a number of groups that the fundamental methodology is the same.
Yep.
And I won't go through the detail now, but basically it's the next 10-year return based on what price is now, where earnings are, where valuations are, etc. So I'll bring this chart up now, and I want to go through it with you. Projected 10-year nominal return outlook. So I really like the way Vanguard do it, where they have a central expectation, which is the 25th to the 75th percentile. They have a pessimistic at 5 to 25, and they have the optimistic at 75 to 95 percentile. And you can see here that we have inflation sitting at around 3%, with pessimistic, down to 0, and optimistic maybe at 4.
Yep.
And that's annualized over the next 10 years. So you're going to have some spouts of really high, some really low,
Sure.
But that's a central expectation. The thing I wanted to really probably just focus on is Aussie equity and global equity, and they've got hedged and unhedged here. Interestingly, have a look at hedged versus unhedged. Such a tighter band, right?
Where is hedged?
Hedged. That's global bonds hedged. I'm sorry.
Oh, yeah.
I was wondering why the return was so much lower than equities. My bad. So maybe just focus on AU equity and global equity unhedged. A central expectation annualized for the next 10 years could be anywhere between, let's say 2% and 8%, 7%, something like that.
Which one? Aussie?
For Aussie equities.
Yep.
In the yellow. And then you've got global equities. Vanguard's projected 10-year nominal return outlook is somewhere between, say, 2.5, 3 to just under 10.
19. Yep.
And we could have an optimistic outcome there. We could have a pessimistic outcome there.
Yep.
The next chart I want to show you is because the question gets raised, well, how accurate is this forecasting?
Mm-hmm.
And I think you and I have talked about this in the past. I don't think it's. I'd rather use the word expected return rather than forecasting, because I think the expected return just sets it up a little bit differently. It's never perfect, and if it's perfect, it's pure fluke and pure chance. I think the important thing to look at is the direction and how, like, what range we're sitting in. So I'll bring this second chart up here from Vanguard. This is returns for a 60-40 portfolio, and you can see the light green band, which is the black dotted line is the median expectation. Then you've got 25th percentile, 75th percentile.
Yep.
So everything in that range could be, that's the base case scenario.
Sure.
Have a look at, and the only time you will know, so if we make a prediction now as of 1 July 2022, we will only know if we are right 1 July 2032, in 10 years' time.
Yep.
Because you never know when that return is going to come. It could all come in the 9th year. You could just have a banger of a year, up 60%, and that's kind of made
balances
your annual returns.
Yep.
But have a look at the actual returns that Vanguard have published, which is that dark green solid line from 2011 through to, call it 2020, 2021. They obviously haven't updated their numbers up to 2021. I would have thought they would have done that by now, but they haven't. But have a look at that. It's all in range. It's pretty damn good.
Yeah.
And I reckon if you're going to rely on anything, I think relying on something that has a reasonably good track record of being somewhat accurate more often than not. But you're not going to, the point is that you're not getting those big 15%. What do you predict? What's the S&P going to do for the next 12 months? No one knows. And it's by chance that you've got it right. And I think looking at things over a longer period of time has a lot more, a high degree of confidence. What do you think about this? What do you think about this type of work analysis? And in fact, what investors are expecting versus what the numbers are actually telling us that investors should expect?
Yeah, I agree with you that the longer the time frame you look at, the more likely you are to be somewhat right. You know, so 3 months, 6 months, next week, nobody knows, and it's just a coin flip. But the longer term, you know, we've looked at plenty of data that says over 10 years that if you hold for 10 years on average, you won't lose money. So it becomes a bit more certain. I was surprised that they, not accurate, but the range is pretty damn consistent in terms of the range of expected versus what actually plays out. And if you look at that black line, that black dotted line, really, I mean, it's pretty consistently close to that or oscillating around it, or certainly following the trend of that dotted line. So the consistency is surprisingly high. Just for clarity, returns on a 60-40 portfolio for Vanguard, 60-40 is a growth portfolio, whereas for a lot of fund managers and like the industry funds, that's a balanced. It's not even balanced. I think 70-30 is balanced for a lot of providers, whereas for Vanguard, a balance is actually balanced, being 50-50, which is, normal. Surprising that 50-50 is balanced, right? But anyway, I digress. I was surprised by that. The other thing that kind of jumped out of that chart is Aussie equities, the expected return over the next 10 years, the range there is lower, but with higher volatility. Whereas global equity unhedged, the range is higher with lower volatility.
Yeah, that's a good point, actually.
So maybe, tilting more towards global international makes a hell of a lot more sense with lower volatility and better
and higher expected returns.
Yeah. So that to me makes sense. The other thing that kind of jumped out at me is the cash is pretty much the same as Aussie bonds.
Well, I think their Aussie bond. Yeah, I think their Aussie bond might. I don't know what proxy what index they're using, but it might just be Aussie government bonds. So bonds, cash. It's sense. Kind of
Yeah. But anyway, so no, that's really interesting. And, I guess it also helps keep investors' mind focused on the future, the long-term future, not, next week and next year as we
But if you look at a 60-40 portfolio, which, it's being used because it's a general thumb portfolio construction. But if you look at a median return of expectation of 3.8%, so call it 4%.
Yep.
For the next 10 years, annualized. And even if this goes back to 2011, I've looked at data that goes back way before that, and this methodology is pretty damn accurate. And if let's say best case you're at 5% per annum, do you think investors are going to be happy with that, or do you think investors need to start looking at alternative assets in whether it's in the risky bucket or the defensive bucket to help further diversify and enhance that expected return?
Yeah, I do. Because when you look at that, I mean, whether it's 4 or 5, look at inflation. I mean, inflation's at 4 over the next 10 years. So essentially they're saying...
And this is nominal too.
Yeah, they're saying the 60-40 portfolio is going to return at or slightly better than inflation over the next 10 years. I mean, that's not a great outcome, I wouldn't have thought.
No, that's a good point.
Whereas, so I mean, that's tough, and we keep saying that investors' expectations need to change. I mean, that's a big change. So if you look for the last 10 years, so up till September 2010? No, from 2010 to 2020, it was 7%. So it's going to not quite half, but it's going to drop pretty significantly. I mean, that's a big, big change. And I know that, you talk to people and expectations have now been anchored to a higher number. So to remove that down to a lower number, it's going to be painful.
Well, especially
people's
when
retirement plans are going to have to change.
Well, as inflation's running at 6, 7, 8, 9%.
Yeah, absolutely.
When we talk to people are like, well, I can't keep the money in the bank.
Yep.
I need to invest in something that's going to give me a real return.
Yep.
And trying to then, pull people down to reality and go, guys, just calm down.
Yeah.
Because unless you're doing something different, you're not going to get a different result. You're going to get what you're going to get.
Yeah, no,
I think
agree.
investors really need to start thinking about, how else do you allocate
assets,
your capital?
And how do you allocate more?
More, what do you mean?
More assets to invest. So if you've got an end retirement goal in mind, you're going to have to invest more now to get
what about
there
the retirees who are already retired?
Wow.
They don't have any more. That's a challenge.
It is a challenge, absolutely.
The other thing that just came to mind, like all this analysis that's going on about, mortgages and whatnot. Like, do we ever look at the real rate of return, real interest rate? Like, if inflation's no?
I think no, because I mean, so you're looking at the actual rate because that's what's actually coming out of your. That's what that's the number you're seeing every month, right?
Your loan then effectively, if you take inflation into account, like, isn't that helping?
Yeah.
In real terms, isn't your mortgage
going down
situation not as bad as if I mean that's the thing.
Presuming your wage is keeping up with an asset price.
But even just in real terms, like if you plot out like a 7% inflation rate for the next 5 years, you discount that back, the number's different.
Yeah, it is. And that's what they were talking about during the kind of in the COVID money splurge, governments, throwing money out. And they're talking about debt and how we're going to get out of this. We're going to inflate our way out of it.
That's what governments do, no?
Yeah, absolutely. This is what's happening to us. But the key is income and assets have to keep pace with that inflation, and then it's all relative, right?
Let's move on to the next topic.
All right, so looking forward to a soft landing. So there's so much speculation and doubt, skepticism about whether central banks around the world can engineer a soft landing. That is, they can bring inflation down without putting the economy into recession, an actual recession, as opposed to 2 negative quarters.
Do you know how many people are like talking about now we've had a recession because of the 2 negative quarters?
Oh, really?
Oh, yeah,
So I'm hearing a lot of people now talk about this group that we talked about last week, whose name I can't remember. And everyone's like, oh, it depends on what these guys... I've never heard of this group or organization before, say, 3 months ago. Now everyone's talking about them. Like, oh, I've been talking about these guys for years. Anyway, so I thought I'd have a bit of a look at kind of what are some of the forward indicators showing or saying, because
Right.
it's quite mixed. And we look at we've looked at consumer spending versus confidence, and it's all really mixed. And I kind of view it as we're at this potential turning point where the data's sort of all over the place before it all starts to sync up and head in the same direction.
Right.
So just trying to get a bit of a feel for
what data is going against the positive spending, low unemployment? Because I feel like all the data points are going one way.
Well, let's have a look.
Okay.
Rob. Shall we have a look? All right. So starting with oil. So I'll bring up this first chart here now. This is US.
Gasoline.
And gasoline, which is petrol for those at home in Australia or the UK. Anyway, so this is the price per barrel on the left-hand side, and basically showing that I think we've seen over the last 5-6 weeks, there's been a consistent decrease in petrol prices in the US, which, like here in Australia, I don't know if you've noticed diesel prices. You haven't mentioned that.
No, I have. It's come down.
You're quick to mention when it goes up, but not when it comes down, Rob.
It's like the banks not passing them on.
Petrol's plummeted.
Yeah, it has. Not diesel though. Diesel has not plummeted.
Oh, really?
Still $2.11, $2.17.
Not my problem.
No, it's not. And soon that won't be my problem.
Anyway,
either.
so petrol prices have come down. Why that's interesting and important is transportation is a big feeder into that, which then feeds into kind of your base core inflation number. And obviously, everyone feels it at the hip pocket every week, fortnight, month, however often you fill up. So that's a big one for future spending or saving, as well as future inflation.
Do you think then, like that decline in prices, the fall in that right now comes at like the perfect time whereby consumers haven't been totally wiped out? That, do you know what I mean? Like if prices kept staying that high for that long, eventually the consumer caves.
Yes.
Do you reckon just before they cave, prices just go come right down, and it's like, oh God, we're okay now?
I do.
Do you reckon?
And yeah, I think it absolutely it plays a psychological, if nothing else. I mean, you drive past wherever 7-Eleven, you go, fuck, $2.60 a litre, holy shit. Or you drive past and it's like $1.70, you're like, so $1.70 now feels really cheap. Whereas not long ago, $1.70 was like, holy cow, it's $1.70 and
$30, $40 maybe on a tank.
It's huge, yeah. So anyway, so petrol's coming down, so that's good. And commodity prices, let's bring up this next chart. And I apologize if you're listening and not seeing this. There's tons of charts here. So commodity prices are another input into future inflation, input costs, building a house. It's timber or lumber if you're in the US. So this chart was from Jim Reed, which was really interesting. It's probably about a month old now, but I still think it's relevant. So the dark blue bar is the year-on-year change. The slightly lighter blue bar is the 3-month change, and the light blue is the change from the peak to where we are now. What was interesting is timber in the US is down year on year 6% and down 62% from its peak. I mean, that's
big.
massive.
That is
huge.
big.
So that has big implications for, i.e., people getting a house built. So, consumers or the residents, or the builder themselves. So if the builder themselves has put in their contract, here's the price of timber, and timber's just fallen 60% from when they wrote the contract, then their profits are going to be potentially a lot bigger. So that was interesting. But also, nickel, iron ore, wheat, soft commodities, being helped with Russia allowing ships out of the Ukraine with like enormous amounts of wheat to be shipped into Europe and elsewhere, and Asia. Copper, that's another kind of contributor. So anyway, I guess the theme is commodity prices have come off significantly from their previous high, so that flows into
That's a good point.
Cars and everything else. So that's again another deflationary factor that's sort of coming through the pipeline. Looking at jobs, and the unemployment rate is typically a bit of a lagging indicator. You don't get that till after a month, 3 months after it's happened. But the monthly or weekly jobless claims. I can't remember what they call it now. But anyway, so that's a bit more of a current indicator. And last night we just had the monthly jobs report, so slightly lagging. But that came in a bit higher than what was expected. So more people applying for unemployment than what was expected. So again, we're seeing a bit of a softening here, and we'll bring up this chart now. Slightly lagging, but US vacancies dropped more than 600,000 to the lowest level in 9
lowest
months.
level in 9 months.
So it's still low, but historically it's still incredibly high. So this is the number of vacancies that are out there, people looking for jobs. How many jobs are available and not yet filled? It's still enormously high, but it is starting to soften. So I read off that some of the pessimism is starting to feed through, although we've got a long way to go before we're in any sort of employment crisis. But that's good.
So that dip during 2020 was showing like 4-point-something million vacancies.
Yeah. So dropping from, let's just call it 7 down to 4.5-ish.
Yeah, and now we're at 10.7
So we're
million.
Massive number of vacancies, down from almost 12 million. So it's down quite a bit. What did I say? 600 from the peak. So
Well, it's down almost 20%.
yeah, that's right. So it's down a bit, but it's got a long way to go. But strong unemployment is good. So if inflation's starting to come down, the Reserve Bank or Federal Reserve can ease off in the rate of interest rate increases, but employment holds up, man, that's a pretty good situation.
You're convincing me of a soft landing.
Look out. Let's keep going. So the US ISM manufacturing PMI, so many acronyms, but basically this is the US factory gauge. So a factory is busy or they slow, are they quiet? So this number came out for June, but I don't think we've got July's yet. No, we do have July. Sorry, we just got July's, and that's at the slowest point since June 2020. So factories are producing less than what they were. And so that's starting to feed through that slower demand, whether it's interest rates or energy costs or whatever it happens to be. That's starting to slow down in the US, but still positive, still.
Do you want that chart
expanding? Yeah, we'll bring that up. Thanks, Rob. So it's still expanding, but certainly not at the rate that it was.
So maybe just for listeners, it's above 50 is expanding. Sub 50 is contracting.
That's correct.
And what's that number?
So it's at about 52.5, 52 point.
So it's still expanding, but not expansionary as it has been since post-COVID. And in fact, I remember when I look at some of these numbers, those numbers you see in 2021, they're ridiculous. They're insanely high. They're unusually high numbers.
And that's coming out of lockdowns, trying to remember, like everything shut down. So they've got this backlog plus new orders to kind of make up for. So everything goes absolutely mental. But even, April this year, it was sitting at a 59. So it's come down fairly significantly, but it's still expanding. And I think that's probably the point to watch there. And then this next one, which is US consumer spending, which we've talked about previously. So the reason consumer spending is so important is that it's about 70% of US GDP is consumer spending. So it's a massive forward indicator, and that is still strong. So we'll bring up the chart now. And you'll see that it's certainly come off the highs of 5.4 down to 4.8. It's bounced a little bit. It can be volatile, but I think the trend's the one to watch. So the consumer's still pretty strong. We're still reasonably confident, despite what the confidence index is saying, because they've got jobs and there's still plenty of job openings, so they feel comfortable in resigning and getting a new job. So that's positive, and it's come off the highs. So again, that's some of that stimulation coming out of the economy. And we'll bring this one up really quickly. This is the consumer confidence, which again has fallen down 50 last month, or June, was the lowest ever gauge, the lowest ever reading from the Michigan Consumer Confidence Index. So it's bounced slightly from that. Lowest ever.
Since the survey began?
Yep.
Wow.
I don't know when the survey began, but it's the lowest.
So people were more pessimistic about what's going on now than they were during the GFC, during COVID,
during
the European debt crisis,
Yeah, I'm trying to look when it began. I mean, it's been going.
I think it's 1990. That rings a bell for me, but
It's been going for at least 25 years.
yeah, I think 1990 is the number. But anyway.
No, hang on. I think back into the 60s.
Oh, okay.
Early 60s.
I am wrong.
So, I mean, that's extreme pessimism. All right, and the US yield curve. So we've talked about the yield curve many, many times. Let's bring up this chart really quickly. This is from Bond Supermart, which just tracks. So the one to watch there is the teal color. That
What's teal? Purple?
I don't
Oh,
know,
the green.
The green one. So purple is what it was a week ago. Orange is what it was a month ago. Blue is where it was a year ago, which is kind of stark to look at where we were a year ago to where we are now. But the inverted yield curve, we're pretty much inverted from, I was looking at this, from certainly the 6-month mark all the way down to 10-year. I heard someone the other day saying 2 to 10 is a 70% indicator. 70% of the time it inverts. We have a recession within 3 months or 6 months. Someone was saying that with the 3 month to 10 year, it's 100%. Like we're in.
But
we're
I
in
don't
all
think
sorts of trouble.
I don't think the 3 month, 10 year has inverted.
No, it hasn't,
It's well and truly nowhere near inverting.
No, I think that's not the case anymore. I think it's within like 4 basis points.
Right.
Yeah, so it's getting closer, and if the Fed Reserve raise another 75 next month, I think you might see that 3.
Oh, idiot!
3 to
10. You can't see this, but actually, are you in the dock? You're in the dock.
Yeah.
Where are you in the dock? I'll put that right there. The St. Louis Fed. You got that link there? Just below your Bond Supermart link.
Oh yeah. Yep.
And we'll get that up now. So that's the 10-year minus the 3-month Treasury. And so the reason I think the 10-year and 3-month Treasury is because the 3-month is more reflective of money lending.
Yes.
And how the system actually works, less so than the 2-year. And so if you have a look at that it's almost like it crash landed below zero, but I reckon that's ticked up. On the far right-hand side,
I think it has a little.
That's ticked up. So it was at 0.04 on the 1st of August. And the latest reading is 0.26.
Okay. I got 0.18 as at the 4th of August. But anyway, it's pretty damn close.
It was pretty damn close. And my question...
0.18 is still bloody close.
It's still close, but I reckon it just... What do they say? No cigar? Is it close but no cigar?
Close but no cigar.
Close but no cigar. I don't know why they say that, but they say that. Now, I'm just wondering with all this stuff so was there any more charts you wanted to go through?
No more charts, just some economic numbers. So basically the soft landing is not out of the question in my mind. It was earlier in the year, but I think as long as unemployment can stay at a reasonably low level, this is the US, I think there's a fair chance. Just some other economic news that came out this week. Obviously, the Reserve Bank here in Australia raised 50 basis points to 1.85. CBA, ANZ, Westpac, Macquarie, and I think the NAB have all passed it on to borrowers and to some savers, not everyone. The 3-year yield, which is interesting, is down from 3.7 in June down to 2.64% now. That's fascinating. Down 1% in about a month and a half. That's a lot. That's a big move. So expectations are that we're getting pretty close to peak rates.
Well, we are because we're almost close.
With every rate rise you are, I guess, but we're getting there. We're not too far away. Just a couple of other things in Europe. So I focus on the US a lot. Europe's a completely different kettle of fish. So retail sales in Europe surprised on the downside, falling 1.2% for the month against expectations of a 0.2% decline.
All right.
And against June 2021 retail sales, it's down 3.7%, which I thought that was interesting. Producer prices, same sort of thing, down quite a bit. Up quite a bit. So inflation, on the inflation side, producer prices are up 35.8% since March 2021.
Yeah, okay.
That's huge. And inflation, I think, is just I don't think we're anywhere near peak inflation in Europe yet. I think we're a long way to go.
Sounds like a bit of a mess over there, doesn't it?
It does. And the BOE, Bank of England, came out last night with the biggest increase in rates in 27 years at 50 basis points and said we're going to be in recession for at least 12 months. That's their base case expectation.
I love how it's like, we're going to be in recession, raise rates.
Yeah, and we're going to keep raising rates. That was their other thing. So
what does that make any sense? It's a complete bonkers.
Well, because so much of the inflation is driven by Russia.
I reckon there's lots of bullshit inflation. Is that a thing?
Yeah.
Do you think there's bullshit inflation?
Absolutely. Inflation's going up, so just raise your prices because everyone else is. Because if you don't now, it's so much harder to do when you're in recession. So you might as well raise them now. But don't. Just stop.
Can the RBA gauge or the ABS gauge bullshit inflation?
No. We've gone way over time. Sorry. We'll skip my last topic. But look, I think it's important. And
I think it is important.
A hell of a lot of mixed data. But coming round to, we may kind of skirt through this okay.
I don't disagree with you. And in fact, what I was going to ask is, with everything that you're just going through now, I feel like the way consumers were feeling when all of this started versus where we are now, I think the market and consumers and investors like, actually, maybe it's not going to be that bad.
Maybe our biggest attribute as a human is our ability to adapt. And so you start at interest rates of 0.5, you go to 1.8, whatever the numbers are. You go, shit. And you get there and go, okay, it's actually not. It's bad, the thing, but it's not as bad as what I expected, so I can get by at the moment.
That's why I think the market has a really good way of working itself out. Like every day, it's trying to get to like perfection. Every single day, just little bit by little bit by little bit. It's never, everyone talks about market efficiency and the market's always right. I guess the market's always right because how can the market be wrong?
Because the market is the market.
The market's the market.
What are we comparing against to whether it's right
nothing.
or wrong?
But I think it's this daily pursuit of trying to get to where it needs to get to. And then, you and I have talked previously about oversupplying goods and discounting of those being deflationary.
Yep.
And it seems as though, and look, I'm not calling this a trend, it's only been weeks, but maybe we've just...
Maybe. I mean, I'm
just dodged a bullet here. I don't know.
Way more open to that being the outcome than I was even a couple of weeks ago. It's possible. But that's based on, and this is all, as I've said before, interest rates increase, it takes a few months for it to really kick in. So, yeah, we're probably looking at a fair step up in interest rates or the effect of the interest rates to come. So maybe not, but at this point in time, things aren't too bad, but, they're going to, Fed are still going to keep raising rates, as are the RBA, Bank of England, ECB.
Are they?
They're all going to keep raising rates.
As aggressively as they maybe have been?
Maybe not as aggressively. I'll be interested to see whether the Reserve Bank go another 50 next month.
What do you think
25 wouldn't surprise me if they start to pull it back a bit.
As in allowing the large hikes to really feed through the system.
Yeah.
Continue to kind of suffocate it a little bit, but loosen your grip.
Yeah, wait a couple of months, and then if in September, October, the demand side of inflation is still pushing it, then you can maybe go another 50. But I don't know. Maybe I'm wrong. Maybe they go, well, people are used to 50 now. Let's just keep hammering away until we're on the edge of that cliff. Who knows?
How are we going for time?
Terrible.
Do you want to skip your...
Yeah, I'll skip my last one. That's fine.
Wow. A lot of charts on that one too.
Plug it in next week.
I've got two short topics, maybe just to add on from what you've just gone through. I think that's really interesting. I think it's really important that people are listening to this and people are looking at all of these different gauges and different data points rather than just what the newspaper headline is telling us. Yep. So just on the RBA rate hike, Bloomberg had this article, which I'll bring up now. Junk bond market is signalling the US will avoid a recession. Spreads are close to median for non-recessionary periods. The bonds notched biggest 1 month gains in July in a decade.
That's huge.
And I'll bring this chart up. If you're in the article, Matt, you just sort of scroll down. There's There's a chart there that says wider ahead. I'll bring this up now. Wider ahead, junk bond spreads are lower than past recessionary periods. And you can see the high yield spread jump or increase through 2022.
Just for those that don't know, why did junk bonds, why is the spread increase during those periods for junk?
So what happens is, as different companies who have different credit ratings have their, if you like, their yields on their bonds, people have been in the past not discriminating between AAA rated bonds and junk rated bonds. Mm-hmm. The difference in their yields were being compressed. And so what that basically is saying is, we have no regard or less regard for what these companies are rated. Whereas if you have a look on this chart through, look at the GFC, look at the spread. What that's saying is people want to be compensated very handsomely for investing in junk.
For the business risk.
Versus investing in a company that might be AAA rated.
Yep.
And you can see since 2008, 2009, that spread has come right down, right? And we saw again through the debt crisis. I can't remember what happened in 2015, 2016. And then we had COVID. Again, you got a big spread. But see on the far right-hand side, you've got that sort of U-shape spread rise.
Yep.
But then it appears as though, to the charts that you've just pointed out, it's kind of this point where it just peaked. Everything changed at that point in time across a variety of different data points. And high yield spread is no different. It looks like it's peaked and it's starting to converge again from that of higher credit quality companies as well.
Yeah.
And so this is a pretty good indicator. When you start to see spreads blow out, that's a pretty good forward indicator of what the bond market is anticipating.
Yep.
And the bond market's turning around saying, actually, maybe, just maybe, we've avoided something here.
Mm-hmm.
Finally, what I wanted to just have a look at is Sentiment Trader. Where the hell's my topic? So the question I asked is, did the market just bottom?
Yeah.
I don't know. The optimist says in me, we're done, bottomed out. We're rallying hard from here.
Good time to hear again.
And so I'll bring this chart up in a moment, but just let me set this up. What I'm going to show you is the S&P 500. Mm-hmm. And then I'm going to show you the S&P 500 breadth, which is a percentage of the 50-day moving average. So 50-day moving average is basically a technical trend that measures the last 50 days of the average share price of a company over the last 50 days.
Okay.
And it takes the average. So it's just a trend following measure. And it's obviously lagging because it looks back historically.
Yep.
Actually, I'll bring the chart up and let me go through this for you. Fewer than 5% of stocks in the S&P 500 were in medium-term uptrends in June. Fewer than 5%. Since June, which is that 14th, 15th, 16th of June, since then, uptrends have surged to more than 75% of stocks.
Wow.
So let me just explain that. Up until June, fewer than 5% of stocks were in a medium uptrend up until June. And then from that mid-June, 75%. And so what Sentiment Trader said is, since then, uptrends surged more than 75% on stocks, a cycle that preceded year-long gains. When the cycle happens quickly, stocks showed long-term gains every single time. This shift took only 27 trading days for stocks to recover, the sixth fastest cycle in more than 70 years. So have a look at this chart that's been sitting there on screen for those that are watching. And for those that are listening, I'll try and explain this for you. In the top pane there, we've got the S&P 500. And in the bottom pane there, we've got the breadth, the S&P 500 50-day moving average breadth, right? Mm-hmm. Have a look in January of 2009. We've got fewer than 5% of companies in an uptrend. And basically, have a look at the corresponding period on the top pane. The S&P 500 bottoms.
January 2009?
2019.
Sorry, all right. Oh, yeah, yep.
And so the market bottoms. Yep. And then look what happens when the average, more than 75% of S&P 500 companies' breadth moves above the 50-day moving average. You've got solid year-long rallies there. The same thing happens again in COVID. You've got rallies there. And the same thing just happened now. And over the last 5 years, it's only happened, this is the third time that's happening.
Yep.
Do you think the market's bottomed?
Far out. I want to say yes. I really, really do.
Well, your smart question should be for what period of time? Like
Yes.
as of now, it has obviously.
Look, I think possibly the risk is that inflation, despite what I mentioned earlier, inflation stays high and interest rates keep going up.
That's because bullshit inflation's not coming down.
Yeah, well, that's got to unwind, right? I think it probably has. It's not to say we're going to rally 30 or 40% from here within the next 6 to 12 months, but I think it probably has. I mean, you look at some really good companies like Alphabet and Apple and Microsoft. I mean, they're great, and there's tons of them. They're great businesses trading at what I'd say are really, really cheap valuations. Like historically, their earnings growth is still strong.
Sure.
So as long as earnings can hold up as well, I guess that's the key as well. But as we saw earlier, a lot of beats, some pretty good outlooks coming through. CEOs don't appear to be concerned about what's coming. Some are pulling back employment or limiting hiring, but that's because they just employed a whole bunch of people over the last couple of years. They're unwinding that, and we're probably going to get back to just a normal trend. So I'm going to say, yeah, why not?
How do you then respond to people who say stocks are cheap, but we think there's a second leg down? Don't invest
There could be.
until there's that second leg down.
Right. And what were they saying in the middle of June? What was it? Were we about to bounce then? And nobody knows. We saw, I think last week I was showing about trying to time the market. I mean, it's near impossible. You're fearing the Fed's going to come out with a rate rise, so you don't invest, and then the market jumps 1%. I mean, so look, I'd say if you've got cash on the sidelines and you're worried, but you don't want to miss out, then incrementally get your way in, but start getting your way in because, again, if you miss the 5 best days, you're going to be some 20% below in terms of return.
That's a really good point.
Than where you would have been otherwise. And the best day typically comes around the time of the worst day. So, I mean, it's just keep it simple. Keep investing. Don't try and time the market. And we might go through another down leg, but we're still, 20 odd % down on the NASDAQ and 15, 16, 13 on the S&P and 8 in Australia from the, start of this year. So we're still down a fair amount we can't.
And with everything that's happening, companies the good companies are holding up relatively well. Let's move into director's cuts. I've got a couple of quick short ones.
Fire away.
In Australia, one of the year's unlikely best investments turned out to be a new Tesla. So Tesla 3s with only a few hundred miles on the clock.
Okay.
It's on the dashboard for those Aussies listening. 100 miles. Are selling for, so you could buy a Tesla 3 for about 60 to 70K.
Okay.
What are we now? Yeah, maybe a year ago, early this year.
Right.
And so now they're selling in Australia for $130,000.
What the hell? What are new Tesla 3s selling for?
It's less than that. It's
just
70 grand,
right?
60, 70 grand.
So it's just that you have to wait 18 months to get one or
Yeah,
whatever
you have to wait.
is. Yeah.
I think it is 18 months. And Australia is one of the longest wait times to get your Tesla.
Is that right?
Yeah.
Okay.
So I texted my father-in-law, I texted him this article on Bloomberg and I said, Roger, what do you reckon? You reckon you want to sell the Tesla 3? And he just says, I think he said, not a bad idea.
Oh, really?
You paid 60, 65 for it. You're selling it for 130.
Buy another one for 70.
And just
brand new car. Just wait.
Beer inflation. Aussie drinkers woke up to more than a hangover yesterday as accelerating prices and a quirk
It's outrageous.
in the tax system sent the price of beer surging. In its semi-annual CPI indexation review, the tax office lifted the excise. Listen to how good a journalist. Lifted the excise on a frothy by 4%. It was the largest increase over 30 years, according to the Brewers Association of Australia. And it could see the drink reach $15 a pint.
Wow. Holy shit.
Are we living in Switzerland?
No, we're
what
living
the
in
hell
crazy
is
land.
going on? I also did read that some of the breweries and pubs are saying people are still drinking beer, but they're sort of moving down the quality of beers.
Yeah, okay.
And so they're seeing more and more of their sort of house beers selling a lot more than their higher end beers, so which I thought was interesting.
Yeah.
So yeah, they're the two things that really stood out for me, quirky things that stood out for me this week. What about you? What do you
All
got?
right, so I've got oil company profits. So we'll bring this chart up. So this is just some of the largest oil companies in the world. You've probably heard of all of them. And just their quarter 2 2021 net income versus their quarter 2 2022 net income. I mentioned BP earlier. Exxon, absolutely smashing it. Look at the increase. This is US billion dollars. So quarter 2 2021, 4.7 billion, now 17.9 billion dollars. That's absurd. Chevron, Shell, so on and so forth. So pretty strong trend there. I imagine Woodside, Santos, all those guys are the same here in Australia. And this is the next one. We'll bring this up quickly. I don't know if anyone kind of paid attention or saw this, but Illinois had their
I saw that.
their
That was
Tats Lotto equivalent
crazy.
over there, and the winning pot was 1.3 billion. That's billion with a B, US dollars. That's what one person won it.
won it.
One person won. Well, they've said here in the article 1.28
What do
billion.
you think
whatever.
that does to someone's life? Like,
Turns it upside down.
But in a good
and
way
you're
or a bad
probably
way?
miserable because everyone wants a piece of you. Like, what do you do?
have you read the stats
Move?
that show how many people that win jackpots just
Ah,
blow
it's
it? It's
huge.
gone.
It's massive. Like 80, 90%. Like, it's an enormous
It's like the
number.
athletes that earn, hundreds of thousands of dollars when they're,
Pros get injured.
21, 22,
You're done.
whatever. Well, even just, because how long is the lifespan of an athlete? What, 10 years?
Depends the
Tops? I don't
sport.
know.
NFL is like 3 or 4 years. Like, it's nothing.
And then it's gone.
Basketballs, baseball are higher. But anyway, so here's some just interesting numbers. So in the US, you can choose to take it as a lump sum or equal payments over 20 years, I think it is.
What would you do?
I'd take it equal payments.
Would you?
Yeah.
I'd have a look at the discounted cash flow to see
Wow,
what.
okay, here you go. Here's the discounted cash flow. So $1.28 billion is what you won.
Yeah.
You could take a lump sum of $747 million.
Yeah.
But before you get that, there's a 24% federal tax. So reduce your winnings by about another $180 million. Gone. And then there's the marginal tax rates. So in the US,
you get
it's
taxed on it.
37%. You get taxed.
Oh, right.
In the US, you don't in Australia, my understanding.
They should tax Australian jackpots. Free money.
Yeah, I guess so. Why not tax inheritance as well? That's free money. Anyway, so
That's not free money.
so
Tax has already been paid on that.
so that's another 13. So about another
Topic for next
about
week.
another $100 million that gone. So that reduces your $1.28 billion down to around $470 million.
Oh, wow.
Yeah.
That's a big reduction, isn't it?
That's huge. And then on top of that, you've got state taxes, which could be around 10%. So you're now, I don't know if it's 10% of the 747. Let's assume it is. So now you're down to about,
Mate, you've lost almost
390
45%. Just
down.
to the calculation, you're almost down.
Yeah,
You get half lump
massive.
sum. And what about pensions?
so you're down to around 390 million. You're still doing okay.
But what about the pension? What if you take it as an annuity?
Yeah, so you don't get, it's just treated as income and taxed accordingly. So in the US,
Like a Division 7A loan.
you're paying 37% tax
Right.
on that. So I don't know what that number is, but
It all kinds of ends up being the same thing.
possibly.
So you
400. So you're about 390 million bucks, mate. I don't know. Far out. You don't have to worry about money ever. So it doesn't matter.
That's
does
true.
it? Right.
We're greedy.
That's it.
Greedy beings. Tips and recommendations.
All right. So I forgot my scarf. I was going to bring it in. The greatest
Collingwood scarf.
The greatest and best football league in the world starts up this weekend. But for those listening, it was last weekend, and that's the EPL, the English Premier League, starts up this weekend. Liverpool, who dominated Man City in the Community Shield, which is clearly an indicator of what's going to happen for the rest of the season, as shown by my top. Anyway, that kicks off this weekend. So Optus Sport show the Premier League.
Optus Sport? What the hell is that?
Oh, really? Yeah, they have for the last
Don't you have it like
4 years?
KO? Isn't that what everyone watches now?
No. What's just KO?
Optus
Sport. So anyway.
Do you have like a big box that
No,
sits next to your
it's just
TV?
an app, man. It's like everyone else. They've moved into the current times.
Right.
So I think it's like if you have an Optus phone contract, it's like $6 or something.
Do you have a landline at home?
No.
Okay. I thought you would have got a package with a big Optus box and a landline.
Hello, operator.
Optus.
Or if you don't, it's like $24, $25 a month. Anyway, so Premier League kicks off. Amazing. Some of the best talent in the world. Some of the biggest names in the transfer market have come into the Premier League. So it's going to be a good season.
So you're going to have no sleep?
Yes. Saturday nights are a late night. Although Liverpool kick off the season at 9:30 against Fulham, who were promoted. It's good to see Fulham back in the Premier League. So good luck to the Reds. And I will sing, when Liverpool win the Premier League this year, I will sing Never Walk Alone.
When does the season end?
May?
Yeah, long year.
Yeah, it is. And the World Cup's in the middle of it this year, which could be interesting. Might throw things up. Anyway, mate, what do you got?
I had for the first time a coffee in an edible cup.
Oh, you sent me a picture of
week.
this. It's so weird. I
So
can't wrap my head around it.
Good Eddie
On your Eddie?
I don't know if it's Eddie or Edi, got no idea. But saw it in City and at a cafe on the weekend, and they had it, and I said, I want one of those things. I want to try it. And so it's $2 extra. You got to pay.
So it's cheaper than the cost of a pastry. Assuming it tastes the same. Sorry, keep going. $2 for your
So I had no idea what it was
custard.
going to taste like. Drank the coffee. Coffee was good. And then, because, I'm always conscious about, like, how can I reduce my impact on waste and so forth. And I thought, I'd give this thing a go. And I bit into it, and I was like, there's no way I'm eating this cup. It was just like,
That's awesome.
I just had, I said, Deb, she said, how is it? I said, just meh. It's like nothing. It's not quite cardboard. It does taste a little
cork?
No, it's not. It looks like cork. It looks like a cup made of cork.
Yeah.
But it's made of like, I don't even remember those, like, not muesli bars, but Vitawit bars that are kind of like grainy.
Oh, the bit stringy, but they're not
Not
really.
stringy.
No?
They're sort of more grainy,
Okay.
whole grainy. You can't have them.
No.
I had a look. It contains gluten.
Ugh.
They are vegan,
For once, I'm happy.
but they're compostable and so on. And the pitch is zero waste,
Yeah, right.
except for that white strip of band they put on the cup that says, please recycle this. I'm like, it's not zero waste.
No, it's not zero waste. So it has no taste. Pretty bland. Like the coffee, would that filter into it? Maybe not.
Well,
because then it would
I'm
filter
like,
on the
the
other
boys
side.
are like,
right?
oh, can I have some? And Deb's like, no, the coffee's been sucked into it. I'm like, just lick it off and give it to the boys. So the boys had it. They liked it. One of the kids was up that night. We're not sure if it was because.
It's just buzzing around.
So good, Eddie. Give it a go. It's not my cup of tea.
They need to put some flavour in there.
So I've just on their
cinnamon.
website. Good Eddie has launched the edible cup in chocolate.
Oh, okay.
Yeah,
There you go.
The cup you can eat.
Will you give that a go for $2 or
I'd give it a
$3 or
go.
whatever it is?
But do you know what, man? I would rather just rock up with my keep cup and put it in this, drink my coffee, wash it, and put it away.
And it's all good. Yeah, but how many people have keep cups?
Lots of people.
Oh, the chocolate's only on the top.
Oh,
It's like a little chocolate
I
bit
can
around
see it
the
on the
top.
website. Edible
Yeah.
chocolate cup. Come on, man. That's just like a scam. And I beat from $6.50.
Whoa, Jesus.
This
Man,
is
it's
bullshit
expensive
inflation.
to be environmentally friendly.
100%, man. This is bullshit inflation. What's going on here?
That's only a little bit. I mean, you go buy a block of chocolate, melt it into your coffee, and it's still cheaper than buying that edible cup.
Eat the edible cup and the chocolate at the same time. Anyway, we've gone.
Way over time. If you're still with us, thank you.
No, but I think I think what you shared today was really insightful. I think it's really important that people listen
it's
to.
the first time for everything. Just ignore the other 25 podcasts. This is the one you want to listen to.
All right, guys, we'll wrap up. Jump on
Cheers,
YouTube,
guys.
Spotify,
Go Liverpool.
and we'll chat to you next
Go
week.
the Reds.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management. AFSL 526 798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.